Maybe let's just start with a general question about net interest margins, because obviously that is going to be a theme, major theme this year. You have to think of it in partnership with what the ECB are going to be doing and potentially cutting interest rates later this year. Many people say that the easy times, quote unquote, for net interest margins, net interest income for many of these European banks is actually coming to an end, that 2024 is going to be a lot more challenging on that front.
Look, I think that's a fair assessment. When you look at the BBVA result that you just spoke about, the one item that came below expectation already was the net interest income. And I think that is a broader sign for what we will see over the next couple of days when we have other banks report. And it will lead to more of a need to grow the fee income business that a lot of the banks have shown more muted growth in 2023. So a fundamental shift from tailwinds in net interest income to more headwinds that are likely to come. Driven one side by what is likely to happen in terms of rates, but otherwise also driven by changes in deposit betas, which continue to rack up.
That's a very valid point as well. Let me just come back to how you expect market investors to distinguish between the banks that are more geared to higher interest rates and perhaps more subject to some headwinds when interest rates start moving lower versus those with a more diversified business, income, fee-generating business. Are we likely to see an outperformance of the latter basket versus the former?
Yeah, some of that is priced in, but I think there is an expectation of overall muted economic growth for Europe. That makes it a very difficult market environment. We also expect inflation to be spiky and volatile, which will have an impact on how banks will manage their interest rate books and their associated economics. But the big opportunity for outperformance is on fee-based income for sure.